Hey guys, welcome. We are having another lesson on cash flow statements. Cash flow statements is a very important topic in accounting. In your exam paper, you can expect 65 to 65 to 80 marks just for cash flow statements. So it's going to be very important to make sure that you understand what we mean by cash flow statements, how to prepare it, how to comment on it, and also how to analyze ratios as it pertains to cash flow statements. So we're going to start with the learning objectives of this section. So the first learning objective is the purpose of cash flow statements. Why do we need to prepare a cash flow statement? I mean, we already have the income statement, we have the balance sheet. Isn't that enough already? Why do we need to prepare cash flow statements? And then the second one is to understand the difference between accrual and cash. So we know that, for example, that someone can buy something on credit when the other person can also buy something for cash. So we need to be able to talk about accrual and also be able to differentiate it from cash. If you look at the income statement, for example, when we prepare the income statement, we prepare the income statement on the accrual principle, which is also called the matching principles, where we basically match the incomes of a particular year with that particular year. So if for instance we've used up electricity for a year and we haven't paid for it, that would be classified as an expense in the year that we used the electricity, not necessarily based on when it was paid, but when it was done. So that's how accrual works. And cash basically deals with what was paid and what was received. The time doesn't, it matters less when you do the income statement, but when you do the cash flow statements, that when it matters more. And then we have major classifications of cash flows. So we have cash flow that comes from our operating activities, and we have cash flow that comes from investing activities, and we also have cash flows that come from financing activities. So we know the operating activities, those will typically include things like sales, your daily expenses, your taxes, and all that kind of information. And then when it comes to investing, this is when the business is investing, say in PPE, if the business buys new land and buildings, buys new cars, purchases another fixed deposit, whatever the case may be. So that will be the cash that relates to the investing activities. And lastly, the financing activities. So financing activities, we know that when we talk about financing in accounting, you can finance in two ways. You can either finance using your own capital, that means issuing shares, or you can finance your business using loans. That means that you go to the bank and ask for money and then you finance your business. So those kind of cash flows will be dealt with in cash flows from financing activities. And then we're also going to learn the format of the cash flow statement. And then we're going to do the different sections, the operations section, the operating activities section, investing activities section, as well as the financing activities section. So let's go. So what is a cash flow statements? This is a report. It reports basically inflows and outflows of cash during the reporting period. So if we're reporting for a year, it will report how much cash came in during January to December and how much cash went out during that period as well. And then after that, we'll calculate how much we were able to generate in cash for the year. And it almost looks like a summary of the bank account, because if you look at a bank account, whether you're looking at the ledger, there's going to be a lot of things that go into that ledger, because every time when someone pays, you record in that ledger. Or even if you're looking at a bank statement, there's so many transactions that happen there. But when we do deal with cash flow statements, we just summarize those things and say, well, this was operations, this was financing, and this was investing activities. So it serves as a summary that way, because we classify things separately. Imagine if you had to look at a bank statement, you'd be recording things like bank charges. So those small things that um, it would be a million transactions a year. So it wouldn't really work as it relates to reporting, because reporting must be very precise and it must mean something to the person that is reading the financial statements. No one wants to read that you paid £5 in bank charges when they read your financial statements. And it categorizes cash flows according to whether they are from operating, investing, or financing activities. I've already said that. And it allows the user to determine the quality of the profit. I mean, that is the extent to which profit was the result of cash flows rather than an accrual basis. So this is, of course, very important because we know that profit is a work of operating activities. So you understand that, right? Because profit, that's where you get your incomes and expenses. That's when you're trading and you're incurring expenses, everything that's happening on the daily. And then at the end of the year, what you do is then you calculate the profit, sales minus cost of sales, gross profit plus income, gross operating income, less expenses, your operating profit, and then you add your interest income and subtract interest expense, and then you get the net profit before tax, and then you subtract tax, and then you get the net profit after tax. So those are the operating activities. But the thing that you do when you're calculating profit in the income statement is that you obviously use the accrual principle, which does not always match cash. So for instance, if as a business we make credit sales of 500,000, um, so credit sales to a customer for 500,000, what you're going to record in the income statement, you're going to record that you made sales of 500,000, whether that person bought for cash or for credit. We're going to record sales of 500,000 and then we're going to calculate profit using that 500,000. So say the only things that happen is that we made a sale of 500,000 and then we have cost of sales of 200,000, and one had cash and the other one didn't have cash. So in that case, we'd have a profit of 300,000 in both situations. But if you go to the cash flow statement now, we need to understand how much of this profit is actually in cash, because what you cannot do, you cannot pay employees with profit. You cannot pay your suppliers with profit. You pay your employees, you pay your suppliers with cash. So cash is king. So we need to make sure that we analyze that quality of profit. If you made a profit of 1 million, but you only managed to generate 200,000 in cash, what does that mean? So that that cash flow from operating activities is very important when we analyze the quality of the profits that the business has made. So let's go forward. So these are the things that will be cashed in on your cash flow statements. Firstly, it will be cash generated from operations. So if you generated cash from operations, it'll obviously be on cash in. And then if you receive interest, it also, if you receive dividends, if you have tax refunds that have been received, if you made a cash disposal of a non-current asset, and if you have cash that you receive from a maturing fixed deposit or investment, or if you have taken a long-term or short-term loan, and also cash that you receive from issuing shares. So let's try and classify these. So the first one, that will be under cash flow from operating activities. The second one is also cash flow from operating activities. This one is also cash flow from operating activities, as well as the tax refunds. That's the cash flow from operating activities. And then here, cash disposal of a non-current asset. Well, these are investing activities. In other words, here, this is disinvesting. You are getting rid of your non-current assets. So that would be a cash inflow under investing activities. And then cash on maturing investments. Again, that is investing activities. You had a fixed deposit of 100,000, and now it is maturing, and they pay you back that deposit. So you need to record that as an inflow, on investing activities. And then the long-term and short-term loans taken out, that will be financing activities. As we already said, that the business finances either by loans or by equity. And then lastly, cash from issuing shares. That's obviously a financing decision because you issue shares so that you can finance the equity. And then if you look at cash out, so firstly, we have cash utilized on operations. So if you didn't generate cash from operations, it means that you utilized cash on operations. In other words, cash was used in operations. it will rarely be the case. I haven't found any past paper that has cash utilized from operations. Normally, a business makes money on its operations. If you're a business and you're not generating money, you're not earning any type of cash from your operations, you are doomed to be closing soon because sooner or later you're going to run out of money because money should primarily be coming from operations. Money shouldn't be coming from um, issuing shares. You take money from issuing shares and then you invest it in operations, and the operations should then generate some form of money in order for the business to keep continuing. Otherwise, if it keeps continuing for a long time, then you get to a situation where the business would have to close down because you are constantly losing cash. Remember, guys, cash is king. Interest paid. So if you pay interest, we're going to include that on the cash out. That's also from operating activities. Dividends paid, that's operating activities. Tax paid, that's also operating activities. So if you look at these: interest received, interest paid, dividends received, dividends paid, tax refunds, tax paid, these are all under cash flows from operating activities. But you have to what mostly happens though is that under cash flows from operating activities, you will have cash generated from operations, and then you will have these three. These three: interest received, dividends received, and tax funds received. Rarely occur. They rarely occur. So if you have to guess in any situation whether interest was paid, dividends were paid, or tax were paid, I would say guess that it was paid. If you're guessing, but if you know what you're doing, then you wouldn't have to guess. You would know. And the purpose of doing these lessons is for you guys to know between what was received and what was paid. And then there's cash purchase to purchase non-current assets. So if you pay some cash to purchase a house, to purchase a vehicle, but it has to be a cash purchase. So if they talk about a credit purchase of a vehicle, then we will go to cash flow statement because it doesn't affect the cash position of a business. And then cash paid to purchase investments. Again, if you invest more in a fixed deposit, money is coming out of the business, so that's a cash out. And then also long-term and short-term loans repaid. So if you repay the loans, that's obviously cash coming out. That's financing activities. And then cash dividends. Well, cash dividends. So if you pay dividends, cash dividends would go to that dividends paid and not go under financing activities. And then lastly is the share buyback. So if the business buys back some shares, then they're going to include that in their financing activities. Moving on. So this is how the format of a cash flow statement looks like. You get cash flows from operating activities, and then you add your cash flows from investing activities, and then after that you add your cash flows from financing activities. It depends really on what whether so cash flows from operating activities, we're going to have that, and then we can either make we can either generate cash from investing activities or we can lose cash. Most times we'll lose cash because businesses continuously invest in their assets more than they sell them. If you're selling more assets than you're buying, you're probably on your way to closing your business because at some point you end up with no assets if that keeps continuing for a long time. And you can't run a business if you don't have assets. And then cash flows from financing activities can be either. And then once you say cash flows from operating activities, plus or minus cash flows from investing activities, plus or minus cash flow from financing activities, then you get the net change in cash and cash equivalents. And then you add or subtract cash and cash equivalents at the beginning of the year. If you have a negative balance in your bank account, it will be on the negative side, which is the bank overdraft. And then you'll end up with your cash and cash equivalents at the end of the year. So let's talk about the operating activities. These obviously they relate to day-to-day transactions of the business, and then they also include interest, taxation, and dividend cash flows. The operating activities section has two parts. So the first part obviously is the section where you calculate the cash generated from operations, and then you go to the cash flows that relate to interest, taxation, and dividends. and dividends. Yes. So that would be so the first one would be the reconciliation between net profit before tax and cash generated from operations. We're gonna do one at some point. Categories of a cash flow statement. So we have investing activities. These relate to purchase and disposal of non-current assets. And then lastly, we have financing activities. I said cash, but I actually meant cash. Cash flows relating to non-current liabilities and share issues, as well as share buybacks. I should have included that. So this is how a cash flow statement is going to look like. You're going to have cash flow from operating activities, and then you're going to have cash flow from generated from operations, and you're going to have interest paid, dividends paid, tax paid, and then you're going to add all those, and then these ones will obviously be in brackets. And then after that, you have cash flows from investing activities. If you sell a fixed asset, you obviously get cash, so it's a positive. And then if you purchase a fixed asset, that is a negative cash flow because cash is coming out. And then if your financial instrument, or say a fixed deposit, for example, matures, then you receive money. And then if you purchase a fixed deposit or you put money in a fixed deposit, then cash comes out. And then after that, you have financing activities. So if we make a share issue, so if we issue shares, we want to get money. If we repurchase shares, then we lose money. You can see with the brackets there. And then if we take out a loan, we get money. But if we repay a loan, then money comes out of the business. And then after that, we will then add or subtract the cash and cash equivalents at the beginning. And then if we add the net change plus the cash and cash equivalents at the beginning, then we'll get the cash and cash equivalents at the end of the period. So, and then we're going to look at different notes. So the first note is the one for cash generated from operations. The note can also be called, let me just note this a little bit. This note here can also be called the reconciliation between net profit before tax and cash generated from operations. So what you basically do there is that you take the net profit before tax, right? Because now you are trying to actually find how much of the profit before tax is actually in cash. So that's important. So you take the profit before tax. You don't want the after tax one because tax obviously is already part of this calculation. So you deal with it separately. And then you're going to add depreciation. You add depreciation because in order to calculate profit before tax, you subtract depreciation. And depreciation is a non-cash item. So you add it because you want to cancel that negative, because if you were calculating profit based off cash, then you wouldn't have subtracted it because it's not a cash item. So now you're trying to get to a profit that does not include non-cash items. And then you add back interest expense because also with the interest expense, you also subtracted interest expense in order to calculate the net profit before tax. And the reason for adding interest expense is none other than the fact that interest is taken into account separately in the cash flow statement. As you can see there, interest paid. So you don't want to take it into account when calculating cash flow from generated from operations and then include it again here. So you just want to include it once and then take it out of your profit. And then after you add these two, you get cash generated from operations before changes in working capital, and then you go to your changes in working capital. So there will be an increase or decrease in inventory. So if inventory increases, that affects your cash negatively because it means that you're buying more inventory. And then if it decreases, that's good because it means that you're getting sales. So when inventory decreases, you're going to have a plus. And then if it increases, then you're going to have a minus. And then there's the increase and decrease in trade and other receivables. That's the same thing. If your trade and other receivables are decreasing, it means that the people that owe you are paying back. And if they increase, it means that you are selling on credit. And as you sell on credit, you need to make sure that you replenish the stock every time you sell on credit. So you end up spending your own money while you wait for the people to pay you back. And then increase or decrease in trade and other payables. So if it's a decrease in trade and other payables, it means that we are paying back our suppliers. And if we're paying back our suppliers, then in that case, we are losing money because money is going out of the business. And then an increase in trade and other payables, it means that instead of actually buying things for cash from our suppliers, we're buying more on credit, and therefore we are retaining more cash within our hands. And then after that, after taking, and then you calculate the whole entire effect of changes in working capital, and then you add together with cash generated from operations, and then you'll get cash generated from operations. And then the other notes that are very important is the note for interest paid, which is note 2. You start with the accrued interest expense at the beginning of the year. Please make sure that it's actually interest expense that's accrued. So that will be a negative because interest expense that is owing at the beginning of the year would obviously be paid within the course of the year. And then you would also subtract interest expense for the year that you would take from the income statement, and then you'd subtract, and then you would add accrued interest expense at the end of the year. Sorry about that. I need to make sure I put at the end. It's at the end of the year, but it seems like I just put at the beginning on 2 of those, so it's going to be quite timely to change, but just make sure that you are putting here at the end of the year, and also here at the end of the year. It's written at the end of the year, so that one is perfect. So, and then that would give you interest paid. In many instances, they will tell you that there was no balance for accrued interest expense at the beginning, nor at the end of the year. If the balance is 0 here and the balance is 0 here, it means that what is in your income statement is the actual interest that has been paid. In other words, the interest expense is the same as interest paid. It does happen sometimes, but it's not always the case. So just be aware of that. And then tax paid, the SARS income tax at the beginning of the year. So if you owe SARS at the beginning of the year, which would be on a credit, it would mean that you would have to pay SARS during the year before the next year ends. So in that case, for credit, you'd have an outflow of cash, and then we'd take the income tax for the year from the income statement as an outflow of cash. And then if you owe SARS at the beginning, and then if you owe SARS at the end of the year, that is supposed to be at the end of the year. If you owe SARS at the end of the year, then in that case, we'd have if you owe SARS at the end of the year, it means that that's the amount that you haven't paid to SARS, so it would be positive. But if SARS owes the business at the end of the year, then in that case, it means that you overpaid SARS, and therefore, because we have overpaid, you must include that means that we have an outflow of cash. It doesn't matter if you overpay someone or underpay someone, as long as cash went out, then you have an outflow of cash. And then the other note is dividends paid. So for dividends paid, we have shareholders for dividends at the beginning of the year. So if we have shareholders that we're owing at the beginning of the year, we must have paid them by the end of the year. So that will be an outflow. And then there's going to be the total dividends for the year. You take that total dividends from the retained earnings, and you subtract it all. And then if we have shareholders for dividends at the end of the year, that means the shareholders that you currently owe at the end of the year, then we subtract those shareholders at the end of the year to get dividends paid. And that brings us to the end of our lesson. See you on the next one. Cheers.